Good evening, everyone. In today's class, we're going to find out the computation of amount due to the retiring partner. In previous two videos, I've discussed finding new profit sharing ratios and gaining ratio models and calculation of goodwill. The distribution of reserves, profits and loss credit balance and profit and loss debit balance is just the same as we do in admission. So there is no session recorded for that, but you can watch the admission session if you want. So here I'm going to do computation of amount due to the retiring partner. Amount due to the retiring partner is determined by preparing partner's capital account. So this is the only way to find out what is due to the retiring partner. So I have prepared a retiring partner's capital account, but in full-fledged sum, we always prepare combined capital account, where all the partners' capital account will be prepared in one way. So retiring partner's capital account, debit side and credit side. So the first entry in the retiring partner's capital account is, or in any partner's capital account is, recording the opening balance. So by balance brought down, which is recording the opening balance of the partner's capital account figure. Then by revaluation. So which means we will prepare the revaluation account, and if there is a profit in revaluation, the transfer of that profit entry by general reserve. So if there is any general reserve or any other reserve which will be normally transferred to all partners' capital account in OPSR, hence the retiring partner will also get his share of general reserve. So this is that posting by general reserve, transfer of general reserve. By profit and loss, same like general reserve, if there is an undistributed profit, which means profit and loss account balance appearing on the liability side of the balance sheet. Only then it is called as a profit, and we write it off by passing the journal entry profit and loss account data to all partners capital account in OPSR. So this is the transfer of that entry, posting of that entry. Then by gaining partner's capital account goodwill. So this is the goodwill at the time of retirement. So when a partner retire, if there is a goodwill, if goodwill is valued, the goodwill will be distributed in gaining and sacrificing ratio. In most cases it is gaining ratio. Therefore, gaining partner will compensate the retiring partner. So gaining partner's capital account data to retiring partner's capital account. So that is why by gaining partner's capital account posting. Then if there is any salary commission that we normally give to this retiring partner, then that would be recorded by interest on capital if any. Then to revaluation loss, just like profit, if there is a loss, then it will appear on the debit side of the revaluation account. And either one of this will come, not both. Either there is a profit or there will be a loss. To goodwill, this is the goodwill that exists in the balance sheet. Usually if there is a goodwill already in the balance sheet, the goodwill will be written off. The journal entry is all partners capital account to goodwill account in OPSR. So this is to goodwill, the posting of that entry. Two drawings, if any, made by the retiring partner. Two interest on drawings, if any, by the retiring partner. Two loan. This is loan taken by the retiring partner. So if the retiring partner have taken a loan from the firm, then the loan will be credited. So that means whatever amount that we have to pay to that retiring partner will be adjusted with the amount that he has already taken as loan. So this is the reason why loan is credited. So loan taken by a partner is nothing but a loan given by the firm. So for the firm it is loans and advances. For the firm it is an asset. So firm it is an loans and advances, and it is an asset, so it is removed. So we are crediting loan and we are debiting the retiring partner's capital account. So this is a loan taken by the partner, the retiring partner. Now, once you fill up all these items, and also all this will not come in one sum, only few will come. The balancing figure will be transferred to retiring partner's loan account if the question is silent. If the question specifies the retiring partner is paid in cash, then it will be to cash. Or in some cases, the retiring partner will be partly paid in cash and part of the amount will be transferred to the loan account. So here I have taken the general case where it is transferred to retiring partner's loan account. So this is nothing but the balancing figure of his capital account. So there are few notes or few important points that we need to take into account. One such thing is the retiring partner's loan account will appear in the liability side of the new uh, liability liability side of the balance sheet of the new firm. So normally in a full-fledged sum, you need to prepare balance sheet also. So retiring partner's loan account will appear on the liability side of the liability side of the balance sheet. Unless agreed, the retiring partner is entitled to get an interest of 6% per annum till the time the amount due to him is not paid. So, till it is completely get paid, the firm will pay an interest of 6% per annum on the outstanding balance in his loan account. But the rate might differ as per the question. If nothing is said, we take it as 6% per annum. If the question specifies or if it is agreed again by all partners, then that is the rate which will be applicable. Third point, sometimes at his option, he may take instead of interest on outstanding balance, O/S is outstanding balance, share of profit that have been earned by the use of the amount due to him. So what happens sometimes the partner, the retiring partner may be willing to take a share in the profit for the outstanding amount due to him instead of interest on loan. So this is again at the option of this is left to the retiring partner. So he decides which one he wants to opt for. Okay, these could be important for a 1 mark question. But for a full-fledged sum, we only bothered with the loan amount balance. Now let's do a sum in order to inculcate all. So I'm choosing question number 30. So here X, Y, Z are partners. X, Y, Z are partners in a firm. X, Y, Z are partners in a firm, sharing profits and loss in the ratio of 2:2:1. The balance sheet as on 31st March is so and so. Creditors 49,000, reserve there is 18,500, capital balance of all three partners given, cash, data, stock, building and patent. So these are the items. Now, Y retired on 1st April 2021. So Y retired on the beginning of the year. Alright, on the following terms. Goodwill of the firm is valued at 70,000 and was not to appear in the book. So that means goodwill must be distributed in the gaining and sacrificing ratio. And then bad debts of 2,000 were to be written off. So we need to pass journals for that. Patent were considered as valueless. So this have to be written off. So these two items will go in revaluation account. For this one we have to journalize and post it in the partner's capital account. Alright. Other than that, we need to deal with reserves and we have to deal with, there is no profit and loss account. So we have to deal only with the reserve here. So let's see the working. So here is the working of that question. Let's do some working note. So then we can start the full-fledged sum. So working note number 1 is finding the gaining or sacrificing ratio. OPSR given in the question is 2:2:1. As the question is silent, Y retires, so Y will not have any share in future. So NPSR will be 2:1 between X and Z. When NPSR is 2:1, Gaining ratio is also 2:1. We already done enough sum to understand this model, so I'm not getting into that in detail. So next one is goodwill. The goodwill at the time of retirement is given in the question as 70,000. Goodwill at the time of retirement is 70,000. Who is retiring? Y is retiring. What is Y share in profit? 2 by 5th. So therefore, Y will get 2/5 of 70,000 as a share of goodwill. So 28,000. Now who is going to pay this to Y? Obviously the gaining partner. Here both the remaining partners gain. So X capital account, Z's capital account to Y's capital account, distributing 28,000 in the gaining ratio. Please note it down, goodwill is always distributed in gaining or sacrificing ratio. Then that's working note number 2. Then we have third working note is for the reserve. There is a reserve in the liability side of balance sheet and there is no other profit and loss account or any other reserve apart from this one reserve. So reserve need to be transferred to all partners capital account in OPSR. So reserve account debit XYZ capital account distributed in the ratio of 2:2:1, which is OPSR. So reserve journal is over. Then let's get into, so let's start preparing the revaluation account of the partner. If you read the question again, you'll come to know that the patent should be written off and bad debt should be written off. So for your understanding, I'm passing the journals here. When patent need to be written off, patent being an asset to write it off, asset will be credited. Being assert a debit balance, asset to remove, asset need to be credited. So revaluation account debtor to patent account for whatever the amount the patent has been recorded in the balance sheet. So I think it's 9,000. So to patent 9,000. Posting this entry. Next one, bad debts written off 2,000 rupees. So what is the journal for bad debts we'll pass? It's bad debts account debtor to debtor account and then revaluation account debtor to bad debts. Generally, what do? Bad debts to debtor, provision for bad and doubtful debts to bad debts. But here there is no provision account given in the balance sheet, which means the company is not maintaining an account for bad and doubtful debts. Therefore, the bad debts will be transferred to the revaluation account. So this entry get posted in the revaluation account as two bad debts, 2,000 rupees. Alright, so this is the only two item that comes in the revaluation account. So we find the balance, which means debit side 11,000, credit side no item to record. Therefore, this is a revaluation loss. And the loss is transferred to partners capital account, all partners capital account in OPSR. So distributing this 11,000 in the ratio of 2:2:1. This is the share each partner will receive. Now let's prepare the partner's capital account. When you start with partner's capital account, as I said, the first entry that we pass is recording the opening entry. So all these figures you can locate in the balance sheet. So X capital account balance is 82,000, Y's capital account is 60,000, Z's capital account is 75,500. Then transferring the reserve. The journal I've already passed about. This is just the posting of journals by reserve, the respective shares. Then this is the posting of the goodwill journal. Now, I would like to repeat the goodwill entry in the side so that you can relate it to this easily. It was X capital, Z's capital to Y's capital. This was the journal entry I passed about. So amount is 18,667, 9,000, 3,333 and 28,000 altogether. Now when you post this entry, it's very important to do them in a proper way. So by X capital account, by X capital, by Z's capital in Y's column 18,667 and 9,333. I'm repeating this. By X, by Z, their respective figures in Y's column because Y's capital account is credited by 28,000. So you are putting a credit of 28,000 in Y's capital account. Now in X capital account, which is this and this, in X capital account you will write 2Y and you record this figure. So in X capital account you will write 2Y and you write this figure. Likewise in Z capital account you will write 2Y and record this figure. Because X is debited by 18,667, Z is debited by 9,333. So 2 Y in X column 18,666, 2Y in Z column 9,333. So this is nothing but the goodwill entry posted. Now that's it we have. So everything is posted, reserve, and then revaluation loss is also posted. So opening balance, reserve, goodwill, and then revaluation loss. That's it. Let us first find the balance of the retiring partner. Who is retiring? Y is retiring. So Y's credit side total is 95,400. Debit side 4,400. Therefore, the balancing figure is 95,000, 91,000. Y not going to be there in the organization here on. So therefore, the balancing figure will be transferred to his loan account. So Y's loan account balancing figure 91,000. Whereas X and Z still remains in the organization as a partner. So their balancing figure will be taken as by balance carried down. Alright. Now let's do the balance sheet. So first thing we record is capital balance of the two remaining partner that we found it as 66,333 and 67,667. So this is X and Z's capital balance totaled to 1,34,000. Totaled to 1,34,000. Then Y's loan account, Y's loan is 91,000 as you can see here. Y's loan 91,000. And then creditor 49,000. You can find this in the question. In question, there are three items in the liability side: creditor, reserve, and capital balance. Capital balance obviously changed because we prepared the new capital account. Reserve is distributed, written off or distributed. So reserve will no longer exist. Therefore, no reserve will come in the new balance sheet. Creditor remains at the same value because the question is silent. So 49,000 remains. Cash remains the same. Debtor decreases by bad debts 2,000 rupees. I already showed you the entry for that. Bad debts to debtor. So debtor will decrease by 2,000. So 17,000. Stock remains the same. Building remains the same. There was a patent in the balance sheet previously. That patent is written off, so that will also not appear in the new balance sheet. Now total the balance sheet, you will come to know that the total matches and it is 2,74,000. The next question, question number 31. I would like to quickly explain this question to you so that you can try this on your own. Here, profit and loss account balance is given on the credit side, means debit side, which means on the asset side. So it's a loss. Along with that, EPF is given. EPF is not meant for any distribution. So EPF will stay in the new balance sheet as it is. And then one more few important point is, goodwill of the firm is valued at 2 years purchase of average profit of 3 completed years, preceding the date of retirement. Now, this particular partner, who is Kanika, is retiring on 1st of April 2016. So, goodwill is valued on 3 years profit immediately preceding the day of retirement. 3 years. So she's retiring on 1st April 2016. So which means she's retiring in the year 1617. We need to take the profit of 1516, 1415 and 1314. 1314 and 1415 profit is given. 1516 loss is given in the balance sheet. So while calculating the average profit, it is 1 lakh plus 1 lakh 30 minus 20 because it's a loss. That is how we get the average profit, and through that we can find the goodwill. So this is a new thing in this question. Other than that, it's pretty much same like the previous question. So point number 1, EPF is not to be distributed, which means ETF will remain in the balance sheet, new balance sheet. Profit and loss will be distributed. Then profit and loss is also considered to find out the goodwill at the time of retirement of Kanika. Now here is the working of that question, wherein the goodwill average profit method through this goodwill is 70. Goodwill is average profit in number of years of purchase. It said 2 years of purchase, so it comes to 1 lakh 40. Now goodwill is distributed in the gaining and sacrificing ratio, so journal entry for that. Kanika's share of goodwill is 70,000, that is what being distributed here. Then the profit and loss account debit balance is distributed. Then partner's capital account is prepared. As you can see, all the figures are literally the same like the previous question. So if you pass the journals, I'm sure you will be able to match up this to figure. So now Kanika's loan amount is 3 lakh. The balance in Disha's and Kabir's capital account is 80,000 and 60,000. Now balance sheet. Balance sheet, capital account of Disha and Kabir, EPF will come as it is, Kanika's loan amount, creditor which is not going through any changes. Stock increased, so that is taken into effect. Fixed asset increase, that is taken into account. Bank and debtors remains the same. Hence, balance sheet total is 5,40,000. So this is a basic full-fledged sum on retirement. Hope you understood this question. Thank you.